Welcome to today's market report.
Wall Street equities made little progress on Thursday's choppy session as investors digested economic data after a big rally in the previous session from US Federal Reserve signals that it would slow its interest rate hiking pace. The US dollar index fell to its lowest level since August, and the Treasury yields sank after Fed Chair Jerome Powell said on Wednesday that it was time to slow rate hikes. He also pointed to a protracted economic adjustment to higher borrowing costs and a slow decline inflation, as well as a chronic shortage of workers in the States. While oil futures settled well below their session highs, crude had risen sharply earlier in the session on the chance of further supply cuts by OPEC+ and easing COVID curbs in China spurred hopes for higher demand from world's top crude importer. While equity investors shared signs of moderating inflation on Thursday and an increase on US consumer spending on October, risk appetites dimmed after data showed US manufacturing activity contracted for the first time in 2.5 years in November, as higher borrowing costs weighed on demand. Still, investors saw easing inflation supporting the Fed chair's indication that rate hikes could slow. In the 12 months through October, the personal consumption expenditures price index increased 6% after advancing 6.3% in September, compared with the Fed's 2% targets. We're in a little bit of a limbo after yesterday's huge rally. Investors are still digesting that, waiting on the payrolls data tomorrow. Friday's jobs report meeting or missing expectation could help stocks, as it would give the Fed support for easing rate hikes. All asset classes are one big rate trade. We're seeing the setup as favourable for a rally through year-end. The bias is still bearish. The GBP/USD is having the best day in weeks, boosted by a weaker US dollar across the board. Cable peaked at 123.10, the highest since June.
This is today's market news. Thanks for listening. We'll see you next time.